Welcome everybody back to the Platinum Podcast, episode 4. Just as a quick note, the information in this podcast is general financial information and advice only. This means that the information contained does not take into account your objectives, financial situation or needs. You should consider if the advice contained is appropriate to you and your needs before acting, and consider obtaining advice from a trusted and licensed financial advisor who can address your personal situation. G'day Ash.
Hey.
It's been a while.
Just a little bit.
Yeah, we haven't got our timings down pat for this yet, have we?
Life just gets in the way sometimes.
This is true. How you doing?
Yeah, better this week.
What are we today? Tuesday? Yes, you were crook last week, hence the reason we're a week late on this. That was fun.
Count.
A bit going around.
Yeah, definitely been a bit going around, so yes.
Well, this one is really going to be you. Because this is your bread and butter. This is what you do. Give us a quick intro into what we'll be talking about today.
I guess today what we're going to do is talk about investing. And I guess it's more just going to scratch the surface really, because there's so many things that you can invest in. But I guess it's just to give a bit of an overview of the different types of asset classes that you can invest in. And this is relatable to investments, superannuation.
Yep.
So yes, very, very general, a bit high level today. We're not going to get too detailed.
Definitely do not have the time nor the attention span, I think, to go into what we've been doing really every day for however long you've been doing this for, essentially.
Long time.
Yeah. Where do you want to start?
I guess the first thing I want to start with is the types of asset classes. And I guess these are probably what we tend to deal with on mostly a daily basis. But the ones I've sort of narrowed it down to that I'm going to discuss today are direct shares, managed funds, exchange traded funds, or also known as ETFs, direct property, I'll touch on that a little bit, and then cash. So they're probably the ones that we'll focus on today.
Sounds good. Sounds like we've got a bit to get through. So tell me about direct shares. I'm assuming that's where you want to start because that was the top of your list.
I know. I feel like I've got my notes, but we can bounce around a little bit. So direct shares is, I guess, if you see on the news or if you listen to the radio about what use the Australian Stock Exchange is probably the prime one that most people tend to hear about, or the blue chip shares are probably a common thing. But investing in direct shares is you actually have ownership in a company. So you hold them directly with what's called an issuer, or so all the different shares on the stock exchange have someone that I guess manages the shareholdings on their behalf. So shares range in value, they fluctuate on a daily basis.
Definitely do.
Yeah, and I think that's probably where a lot of people got exposure, was sort of the direct shares. And we'll say one thing, we're not day traders, we definitely buy and hold. But yeah, direct shares are probably a good entry point for a lot of people. Even their bank, you can have investments with your bank. A lot of banks now offer shareholding services too. So if you wanted to dip your toe in the water, then that could be a good start. Sort of minimum is about $500 that you can purchase into that. But we're sort of talking about, especially the Australian market, financial services, so banks, and then resources are the primary exposure that you'll get onto that. But there are a lot of, obviously, you've got the top 200 and you've got the top 300 as well. So there's still a lot in there, and you can get a bit of diversity. But it's that single, I guess, asset holding is what you're looking at. So I guess that's probably where you sort of can get a little bit stuck in terms of just having an exposure or an overexposure to one asset just by primarily going the direct share option. Yeah,
fair enough. Yeah, we do find ourselves checking the ASX website, see what the markets are doing. And as you said, we're definitely not day traders, but we like to keep our finger on the pulse a bit with what's going on. And obviously we do seem to follow the US, to a degree. So it's always interesting waking up in the morning and seeing what their market's done, seeing what we're in for.
Yeah.
But we are almost, I think we were, or might still be almost in a historic high on the All Ords and the 200, which really goes to show the strength of that that market, I suppose, and which is positive. Great place to be if you're already in the market.
Yeah.
But, there's always potential there in different holdings and ways to sort of structure it. So.
Because that's the other thing as well. When you think about shares, it's not just, we said before, obviously the value can go up and down, but you also do get dividends as well. A lot of companies pay dividends. Not all of them do at the same rate, but it is sometimes they'll reinvest back into the company, but other times they'll actually give the profits to investors as well. So it's going next level, but sort of imputation credits and tax and all of that is taken into consideration too. But it's just, a bit of a starting point, as we said.
Yeah, and it's definitely something that, as you said, is the way that we recommend, I guess, to our clients is that looking for the strength in the company, in the holding, not so much a look to sell immediately, and especially when it comes to kids of clients, so they want to sort of set something up for them it's definitely that long-term approach. And we can usually a lot of the times use our example that we've set up, just some small stuff for the kids in that as well, and it just gives them a bit of an interest in the markets and that too. So there's, as you said before, there's definitely different ways you can go about it. And I think the earlier you can start, the definitely the better you're going to be in the long term. Yeah, so.
It's just a matter of starting. So, and I think people, you often through your parents or just people that you have experiences in sort of one asset class over another. So it can be a little bit daunting if you haven't had that experience or exposure before. But as I said, you get daily updates. Like the Australian Stock Exchange works in real time as well. So exactly from one day to the next, like the value of your shares and what they've been selling for as well.
And we don't do a lot of speculative stuff either. So which is handy for us because the last thing we need is clients on the phone in an absolute panic. We definitely look for strength of a portfolio and many other characteristics of how we structure.
And if you need access to funds too, that's the good thing about direct shares is it's called trade plus 2. So if you do end up purchasing shares or down the track then want to sell them, you can actually have your money within sort of 3 days as well. So the turnaround for shares, because we said they are sort of active and you can get real time values, they are quite good to sell and turn around quite quickly.
Excellent. I think the next one from memory was managed funds.
Managed funds. So this is, I guess, and that's why I've sort of put this second, is it's expanding on the direct shares. So managed funds are what are called parcels of shares. So you can have managed funds that are purely Australian shares. So they'll pick like a parcel of shares that they will invest in. And we're talking about fund managers are what manage these portfolios. So we use, I guess, a range of different portfolio managers that we've used over a long period of time that are proven from a management perspective, results perspective. Obviously got to tick a lot of boxes across that. But so managed funds, parcels of shares. So you could be purely in Australian shares, you could be in international shares, you could have property or infrastructure or fixed interest cash. So these are the sort of the different investments you could have. The other thing is, we touched on it, I can't remember what episode was, but when you're talking about super as well, they often use what are called multi-manager managed funds. So those asset classes that I spoke about, they will hold all of them in one managed fund. So that's always the thing is if you're generally in a balance fund, which is like the default that you go into when you first go into a superannuation fund, is you go into a balance fund. So you'll have exposure to all of those asset classes. And I guess that's where it comes down to if you want to be more aggressive in your investment, if you want to be more growth orientated, or if you want to be more defensive, then you can go up or down that scale in terms of those managed funds.
Excellent. Fantastic information there. I'm learning something as we go. This is great.
Don't do this daily, but and I said this is just touching the surface, but from our perspective, when we're putting together portfolios for clients, we don't generally use the multi-manager approach because I guess it's a bit of a blessing and a curse because, as I said, if you want to change, then you have to change 100% of that portfolio. Right. Whereas we will tend to have maybe 3 managed funds that are Australian shares and 3 that are international, and adding some infrastructure and things, because potentially if a fund manager or the shares that they hold in those managed funds are not performing well, we'd rather change one fund than change like the whole portfolio. So we tend to layer it in terms of, and I've sort of probably jumped ahead here, but the other thing I was going to talk about was sort of active versus passive investing as well. So I guess we'll sidestep here if you're ready for that.
For it. If you're going to talk about that in your notes anyway, you might as well jump into it.
Yeah. So this is something we also, and that's the thing, I guess we sort of do this every day, but if you don't have exposure to it, then it's probably a bit of a foreign language. But so active versus passive passive investments is pretty straightforward. So we're talking about the share market before, use the Australian Stock Exchange. A passive investment is a managed fund that tracks that index. So generally those investments are chosen based on their market share. So BHP is a prime example. They've got a pretty big market share on the Australian Stock Exchange, so they will generally have one of the higher holdings in a passive investment that reflects the Australian Stock Exchange. That's sort of the Australian Stock Exchange, but you've also got the MSCI, which is the international, and the NASDAQ. People might have heard of that. So we use those to replicate international like index funds as well. So when I said before about managed funds, so we tend to layer ours. We'll use like an index, say Australian and an international, and then we'll layer it with like more active managed funds, but not trying to give you the same in the portfolio. So we're looking for some differences between the funds that we use, because one managed fund might be more financial focused, and then one might be more consumer focused. So you don't want to have everything in the same investment, because it's good when they're good, but it's not so good when they're doing bad. So it's about diversification within your investment portfolio as well. That was a lot.
That was an interesting little sidestep there. ETFs, I think, were next.
Yeah, so ETFs, I guess ETFs are kind of the best of both worlds when it comes to direct shares and managed funds. They haven't been around as long, so an ETF or exchange traded fund is actually focused on a direct share but taking on a managed fund spin, if that makes sense. So ETFs can be bought on the Australian Stock Exchange, so they're parcels of shares, but via the share option rather than a managed fund option. So they tend to be a little bit more cost effective than investing in a managed fund, because there are fees, I guess, involved in different things. Direct shares, generally there's no fees, but managed funds and exchange traded funds, because you're engaging a fund manager who's selecting the funds in the portfolio, then they obviously have to be paid for their services and looking at everything 24/7 too. So they are a bit more popular, and obviously have taken off as well, so quite diversified. So they do more of that exchange traded fund, like multi-manager type thing, similar to the managed fund, but then you can do individual ones that focus on Australian shares, international shares.
They definitely seem to have become more popular in the last couple of years. As you said, they do offer a very good offering to get exposure across a number of different equities.
Yeah, because I guess we were saying before, if you've got $500 and you want to invest it, you are probably better to invest in an ETF that's going to give you exposure to a lot more funds than purely invested in one fund, because that's always the concern. And we talked about diversification. If something happens to an industry that you've gone into, so use the banking industry at the moment. Obviously, when interest rates were quite low, then banks, they still find ways to make money, but when interest
None
rates...
of them particularly struggle through that.
When interest rates are low, they may not perform as well as when interest rates are higher, because if they've got loans and things. So if you're purely 100% in that, then you're reliant on just that industry doing well. Whereas if you've got exposure to banking, resources, consumer, commodities, all of that as well, then that's probably going to do better, or at least give you a bit more focus on something other than just like one sector.
Awesome. Yeah, they're a really interesting area. I think they'll just continue to grow in popularity for all the reasons that you just said. So definitely something we like to keep up to speed on.
Yeah, and that's the good thing too, because I mean, digital also helps. There's so many apps now that you can have, that you can track. And as I said, if you use your bank to have that next to your like your bank accounts can be in there, and then you can view your shares as well, so you can often see all of that in one place too, so you're not having to branch out too far or go to this website or this website or whatever. So apps have made things a lot more real time and definitely. Visibility as well.
Well, I've forgotten what you had next. I don't have it written down today because this is your show. What's the next one after ETF?
I did put direct property in there. I'm going to say, for some people you either love it or you hate it, or it's not, I guess, something that we really get too in depth about. It's not something we can really advise on, but I have put it in there because a lot of people are very bricks and mortar.
And we do have a lot of clients that that we obviously can't do a lot from it, but it does form a big part of their portfolio and something they are interested in pursuing. And I mean, some people might have multiple properties. I think the big focus is really just on having a diversified portfolio, whether it be some property and then some shares or managed funds, or I mean, another side step, but self-managed super fund is another option that people tend to have properties in that. From my perspective, it's a little bit concerning if you purely just hold a property, because the concern is you can't sell part of a property. It's 100% or nothing. So more so for people that are getting closer to retirement, and you need to be able to access funds as well. That obviously is a little bit of a concern, whereas we talked about shares. You can get that funds within 3 business days. Managed funds, we say generally 7 to 10 business days. So they're a lot more liquid than a property. I mean, we're either all in or you're all out.
I mean, we are in a good market at the moment where it's more of a seller's market than it is a buyer's market. So, but even still, you could have a 14-day settlement or a 30-day probably is the standard. So getting access to funds within a short period of time is always a bit of a concern. And then you've also got the upkeep as well. So in comparison to sort of the managed funds, we said that you do have to pay a manager to obviously invest in those funds, but you've got to always do the comparisons. But obviously any form of investing is good, but it's just being mindful of not over allocating to one asset class.
They're all good. They all come with their risks. They all come with their pros and cons. But I think, as you said, diversification is definitely something we advocate for very strongly. And people love bricks and mortar because they can see it, they can touch it, they can pat it, they can hug it, all that sort of stuff. Whereas you can't do that to a share. You can look at it on your app, but it's quite an intangible holding. People like to show off their tangibles. But I think having a good mix of everything is definitely something that is key for the way that we structure. And in that, I guess that sort of leads on to the next thing as well, in terms of cash rates and interest rates and things as well. If people do have debt on their properties too, then things are getting more expensive, and if you're having to use more money out of your pocket to contribute that as well. So there's always pros and cons, and I guess ebbs and flows with the markets and what's happening as well. So what have you got after property?
Cash is my lucky last.
Cash is king.
So we just touched on it then. So cash rate is obviously higher at the moment than it's been for some time. And I mean, they've been talking about what's going to be happening with interest rates. We sort of spoke about it previously in a previous episode with the Reserve Bank and what's happening, and I guess everyone's got a different opinion on what's happening with interest rates.
Days, probably multiple times a day.
Yeah. So at the moment, cash is good. You can get a good return on your investment by having money in the bank. You've got normal cash accounts like working accounts. You've got high interest accounts. You've got term deposits. And I think the banks have come to the party because a lot of people would have had to previously put money in term deposits to get a higher rate. So I guess the good thing is you now can get higher rates in high interest accounts rather than having to lock your money away, because that's always the concern with a term deposit. If you needed to break that, then you don't get a lower interest rate. So cash is always good. I guess the thing to be mindful of that is you don't really get much growth out of cash. You do get the income, which is good, but it comes back to that diversity again as well. And if there's other opportunities where you can grow your funds, but then it's also that trade-off in terms of how much risk are you prepared to take to get that return, or also goals as well. We haven't really touched on that, but some people might have short-term goals versus long-term goals. So we wouldn't be encouraging people to put something in like a higher risk asset if they're like planning on doing something within, say, the next 2 years or something. So you've got to be mindful of the long term. So cash is always good. You need to have access to it.
It is good, and as you said, the rate's definitely bit healthier than where it was a while back. Where that's going to go is anyone's guess. I don't think it's going to be a huge shift either way, but I think most people are out there looking for a slight reduction, which is good if you've got a home loan, bad if you're in that sector that you were just talking about with the cash investment. So well, I think we did touch on it, like the tale of two factors at the moment, with the ones that are getting higher interest on their bank accounts, and then the ones that are in the mortgage stress as well. So I don't think you've got this one written down, but it's just something that came to me, so I'm going to throw you on. Oh God. You spoke about higher risk investments. The one that's on everyone's lips, cryptocurrency, Bitcoin, bloody whatever other things out there.
I actually did have that on my written notes, but not in my typed notes.
All right, give us your take on crypto.
Well, legally, I can't advise on it. It's been a conversation. I think that there was a period of time where every second person was asking about it, but I think people say if the taxi driver's talking about it, it's kind of too late. I think that was a saying. Yep. My feeling is don't invest more than you're prepared to lose, because as we've seen, it can be quite good, then it can be quite bad. So being that it's... So you mean if I put $1,000 into it, I'm not going to be able to retire next week? No, I think you need more than $1,000 to retire anyway. But it's, to be honest, it's not anything I really sort of looked into, because I guess I know it's not something I can actually advise on. So that my old adage is don't overcommit. I mean, definitely people definitely test the water, and I don't discourage them from doing that. But it's back to don't invest more than you can afford, really, or don't bet the house on it. That's fair. That's fair enough. It seems every second person there for a while was the next Instagram millionaire about putting up their crypto thoughts and advice and all of that. But it's definitely one of those real risky ones that I wouldn't be probably in the same adage that we've sort of said of everything else. Diversification. If you want to dip your toe in it, fill your boots. But as with every investment holding, there is an element of risk. There is just do research. Because people have gone down the path of borrowing to buy crypto as well, and that's an extra layer of like gearing. So that's always concerning too. I mean, we do, I'm authorised to provide advice on gearing and loans and all that. But I guess the thing is, because it's not governed as well, I mean, the government would love to get hold of it and actually legislate it and be at it. But the issue is they just can't track it at the moment. So yeah, just be mindful of leveraging and because obviously you pay that higher cost of the loan costs as well as then going into a investment that is quite volatile.
Yeah, and that's a whole different, that's a whole another episode around gearing.
Yep, definitely.
Do you have anything else that you wanted to cover off on? So we've spoken about direct shares, managed funds, ETFs, cash, direct property, crypto.
Yep.
We've covered a bit. We have covered a bit.
So the only other thing I guess I did put it down was just sort of like a growth versus defensive, which I think we've touched on before as well. So, and I guess that comes back to the whole multi-manager type things, growth versus defensive. So just be mindful of checking your super, having a look at your portfolio. So when I'm talking growth investments, we're talking about Australian shares, international shares. I include property and infrastructure in that, and then your defensive are your fixed interest in cash. And we said sort of comparing apples with apples. So if you're in the default, say, balance fund, it's not always comparable from one super fund to another. So always just have a look at that. Next level for that is some super funds often have unlisted assets in their portfolios as well, or alternatives. So we haven't sort of touched on them, but a lot of them can have exposure to other infrastructure projects and things that are actually not listed on the Australian Stock Exchange or any of the exchanges. So just be mindful of your asset allocation within your super or your investments, or and sort of what your overall allocation is to growth compared to defensive. So it's all getting back to sort of where you are in your life stage as well. So
that's awesome. That's fantastic information. You're a wealth of knowledge when it comes to this stuff, aren't you?
Sometimes.
I think one thing I do want to reiterate is, don't listen to, Barry at your next barbecue that, knows what he's talking about. It is, when it comes to investing and parting with your money into something like that, it is really important that you seek advice on this from a professional, a licensed professional, because there are so many factors that need to be taken into it. And touched on it before, where you're at with your life, what your goals are, what your structure is set up, holistically at the moment. So before you do anything, we implore you to seek qualified financial advice, because it can be a minefield out there. But that's why we continue our education around what we do so often, is because we kind of like to know we know what we're talking about.
Yeah, and on that as well, be very careful about things that you see on the internet in terms of clicking on things that are giving you guaranteed returns. It's always a little bit concerning and I mean, you hear it always in the media and people that are being scammed or fraud or whatever as well. So
as wonderful as this technology age is, it's fraught with danger. And,
definitely.
People can get exposed very quickly and taken advantage of, unfortunately.
Yeah, exactly.
They're getting better, more sophisticated, and especially with the introduction of AI and...
if you're ever unsure, just don't click on a link. Or if you get sent something, then go to their website direct as well. So do your homework. You can always search for like licensed advisors on multiple, like the ASIC website. That's our people that are in charge of us. Sorry, mental blank. I'm all out of whack with all my comments.
As always, if you have any questions, even just want to get a bit of general point in the right direction from us, we are more than happy to assist. Our contact details are in the show notes. please reach out. If you've got any questions or comments on anything that was discussed in this episode, want some clarification, more than happy to have that discussion as well. Touch base with us, hit us up, and we'll definitely get back to you, and hopefully we can help.
Yep.
But yeah, there was definitely a lot to take in on that one. That was really good. Definitely a lot of pearls of wisdom there from you, and some really great information. So thanks for sharing that with us.
No worries.
We will do this again next week. We will do this next week.
Keep us on task.
Absolutely. Have a great day.
Bye.